Hello and welcome to Super Insider, a podcast brought to you by Australian Retirement Trust on all things superannuation and retirement, so you can have the best possible life once you finish work. Now, I'm Anne Fuchs. I am Executive General Manager of all things advice, guidance and education here at Australian Retirement Trust. And I'm thrilled to be able to bring someone very special to the show today. Before I introduce him, I just want to remind you, of course, this is general advice only. So please don't act on anything you hear today. Make sure you go to our website, give us a call, get some financial advice from us or your advisor, or if you're a member of another super fund, give them a call. Now, Ian Patrick is on the show. Yes, he is, people. I am so excited. This is the man, our Chief Investment Officer, who was responsible for our over $300 billion of assets and many of the talent of Super Insider, like Brian Parker, Andrew Fisher, Elizabeth Kumaru, are in Mr. Patrick's team. And he's been with Art for over 9 years. And we finally got him on the show.
Oh, Anne, it's a pleasure to be here. Got in the door eventually.
Yeah, so I was hoping you were going to kind of dress up like Bono or like, you know, being the sort of rock star that you are in Art, but you're in your suit and you're here to talk business today.
Business, always.
Always business. So we're, you know, in that spirit of, you know, stars, we've got the star questions that we get asked, the top 10. What was that show? Countdown. I'm showing my age here. The Countdown, the top 10 questions or smash hits back in the 80s and 90s that you, our members, are thinking about when it comes to your very precious retirement savings. So, Ian, you ready to go?
I am.
You got your seatbelt on?
I got my seatbelt on, my skates on.
Yeah, good. Okay, so I think for our members and Australians generally thinking about super, a lot of them wonder, what does great actually look like? What should I be expecting in terms of a great outcome? And how do you as a fund achieve that?
I think the best thing we can do when we set about investing for our 2.4 million members is deliver what's on the tin, or in other words, what's stated in the PDS or the investment guide as the objective we're seeking to deliver. And why do I say that? History will show you that if you shoot for the stars and aim for the top return in the industry, chances are you could be at the bottom of the pack in the next year or the next quarter. What we want is steady delivery to what we've said we will aim for, and the way we go about that is building diversified portfolios of a multitude of assets and using the managers around the world whose skill we really respect to invest on our members' behalf.
Okay, and so I think Andrew Fisher, who heads up our strategic asset allocation, has said before on the show, it's not one big decision like you've referenced, it's just lots of little good decisions. And I instantly think of a tennis analogy. Mm-hmm. And, you know, there are some tennis players that do the big point, they take risks. I won't reference any tennis players, but am I right in terms of the analogy or the thread I'm trying to pull here to help our listeners and viewers around the strategy to employ to get what's on the tin?
You're right. What you don't want to go for is hero shots, to stretch your analogy a little bit. You want to be able to consistently hit the percentage shots that through time will build up a series of match-winning potential or potentially match-winning points. That is what you want to do. At the end of the day, we do have to place bets. You cannot gain return without taking some risk, but we want to place bets judiciously, and then we want to ensure that they diversify each other so that the return follows in most environments.
And my bet is those bets, that sounds ridiculous, have been rehearsed to a degree and really thought through. So you're not doing a hero shot and you've never sort of tried it before. You haven't thought it through. You haven't done the maths.
And I think that's one of the fundamental laws of investing. Start with what you have as a set of beliefs about investing, where you can bring your comparative advantage or your skill to bear to be successful. Don't stray outside those tram lines, because if you stray outside the tram lines into thing that you have, an area that you have little skill, I think it's going to surprise you. And so you want to stay within your area of competence, and you want to make sure that you make a big enough call that it's going to benefit the portfolio if you're right, but not so big it'll hurt the portfolio if you're wrong.
Yeah, people generally don't like surprises or bad surprises when it comes to investing. When you think about the difference between super savings and QSuper and the historical returns, we have had a lot of questions from members about that. And some were surprised, I guess, at the difference between the two. Are you able to probably just explain, around why that was so?
Sure.
Is that okay?
Yeah, with pleasure. I'll come back to the statement I made a couple of minutes ago about beliefs. Those two portfolios start from a slightly different point in terms of beliefs. In the case of the QSuper balanced option, now called Balanced Risk Adjusted on our new menu, that was a belief that through time one should mitigate the effect on the portfolio of an equity market downturn or a crisis event in equity markets. Rather go for less downward movement in the portfolio due to share market declines and aim for gradual wins through the cycle, 10 years of that option. Whereas the super savings version didn't have quite the same outlook on protecting against downside volatility or the effect of share markets. That means they had different strategies, which is the key point there. You were investing in different mixes of assets, and so they'd perform differently in different market environments. And in the recent 2 years, share markets have absolutely run away, and fixed income investments have been very, very mediocre. The super savings option had a little bit more in shares. The QSuper option had a little bit more in fixed income. That differential, which has been as high as 15% over the last 2 years, that's what's caused the difference.
I think it's probably worthwhile explaining too to our listeners and viewers that probably intuitively most people would think about fixed interest and shares behaving really differently and acting differently as part of a diversification strategy. However, that hasn't necessarily been the case. That isn't as true as people would think it is. And that's why there are other asset classes that play an important role in terms of what we believe around achieving what's on the tin.
Correct. So if we only had shares and fixed income, which is typically government or corporate bonds at our disposal, we'd have a broadly diversified portfolio in terms of the number of shares or number of bonds you could hold, but you wouldn't have the exposure to very small companies starting out. You wouldn't have exposure to large infrastructure assets like major airports. It is those kinds of assets that come to us through what we call unlisted assets. That's infrastructure, private equity, real estate, many of the office buildings that we inhabit, and private debt, lending to private companies. All of those play a role in the portfolio because they're opportunities that we can invest in, just not available on a listed share market.
And I think that's one of the amazing things about this merger between QSuper and SunSuper. It's allowed us to to launch this new investment menu with a breadth of investment options, particularly for our QSuper members. It's opened doors overseas in terms of investment that may not have been open to individual funds, but also I think that the investment strategy the QSuper members are used to is now the default for our retiree members. Why is that, Ian?
Well, the way I look at it, in the same way that we want to access the best investment opportunities for members' portfolios, we want to make the most use of all the skills that came to us by virtue of the merger. And the QSuper investment approach had a particular set of strategies or skills that are very useful to retirement. I spoke a little bit earlier about moderating volatility or protecting you against the worst of share market downturns. That's particularly important for retirees because retirees don't have the same amount of time to remain invested to recover when the share market has a sell-off and then rebounds. So mitigating against that drawdown, as we call it, is incredibly important. So bringing that skill set from the QSuper approach to what is now the default for retirement, balanced risk adjusted, that's incredibly important. And that's what we've sought to do, diversify what members have access to in the same way that we diversify portfolios.
And also too, retirees are actually drawing down an income. So there is that sort of sequencing risk, I guess, that they are selling assets every time they get their income paid to them, which would be another factor into the strategy, would it not?
Correct. Yeah, it's a combination of you're drawing income, so your balance gets smaller and you don't have the ability to capture those rebound returns on the same size balance. And you're not able to put in future contributions, often referred to as your working capital. When you're earning money, you cannot put more of that in. So you do need to ensure that you've got the appropriate investment strategy through that income drawdown.
Speaking of investment strategy, many of our members, young, middle-aged, older, cohort, really interested in doing good with their retirement savings and the making the world a better place whilst also generating an income in retirement. What have we learnt about the ESG investing, and how has it informed how we approach it at ART?
I think the world at large has learnt, and ART is no exception to that and has taken it to another degree. The world at large has learnt that whether it's the risk of climate change, whether it's the risk of poor labour practices, whether it's the risk of lack of diversity around a board table, each of those things is a real risk to whatever we happen to be investing in. And being attentive to those risks, and then to the extent we can, working to improve the practices within companies through casting votes at annual general meetings or whatever it happens to be. All of that is absolutely critical to ensuring that we deliver with our capital, hopefully a better world, but at minimum not a worse world than what we set out to invest into today. That's absolutely crucial, because if you don't take account of those risks, I'm quite convinced that there will be a diminution through a full period of time to the value of your assets.
And do you think that it's well understood around really the role of the indices? Well, actually, maybe explain. Let's frame it this way. Maybe explain, if you're someone who's really interested and around ESG, the ASX and exclusions, not exclusions, how does that apply? Because there might be companies that may not be aligned with your values when it comes to ESG if you're just investing in the index, for example.
Yeah. So in general terms, the index, like the ASX 300, represents all the available companies in proportion to their market capitalization or their worth. And so each and every company that meets the listing rules gets to go in. There's no other filter. When we think about investing, and I'll give you a classic example at the moment in relation to thermal coal, we think that companies that derive a high proportion of their revenue from mining and selling thermal coal to external entities are at risk of becoming stranded assets. You just don't know when that could be reflected in the price. And we think it's in members' best financial interests to therefore exclude those dedicated thermal coal mining companies from our portfolios. And so we have an exclusion. At our base level in portfolios, we have a small number of exclusions. However, if you have a more values-oriented approach and you want to see a greater level of ESG screening applied on your portfolio, you can select the socially conscious balanced option, which would have a subset of the ASX 300, going back to our opening comments. Okay,
so I'm gonna do rapid 4 questions for you around nation building, gold, geopolitical and currency. Advance warning. We'll start with gold.
Mm-hmm.
Members do wonder, why don't we invest in gold?
We don't invest much in gold, although I will note...
I notice there's a finger point there.
Oh, that was not intentional, sorry.
No,
I was going to say one.
Okay.
One instance, when we came out of the GFC, government bonds were not a great defensive asset, and QSuper portfolios had a small exposure to gold, which leads to why gold. Typically, it's seen as a safe haven in times of crisis or market stress. Luckily today, government bonds generating the yields that they do offer that kind of defensiveness, and we have other defensive strategies. Gold doesn't pay you an income, and you need to store it somewhere, and you need to pay for storage. It is those two factors that don't make it the most attractive defensive asset relative to the other options we have.
Okay, and so when you talk, I'll pull the thread, and you talk about unstable times. The world does feel unstable right now. How is the team? How do we factor that into all of the risks that are facing the world, really, and members' precious retirement savings?
It is tricky to do so because it is often not the event itself. And if I think about the Middle East, it's not necessarily that event, as tragic as it is, that leads to a medium to long-term impact on markets. It is the fact that there may be disruption to oil supply and all the implications that disruption to oil supply may or may not have to economies, to profitability of certain companies, etc. That is the kind of scenario or second-order implication we need to think through. There are many geopolitical potential events and actual events in the world. The US election in and of itself is an interesting geopolitical event, but if you go back through history, elections themselves do not fundamentally change the course of markets. Longer-term policy that flows from an administration in government, they tend to impact economies and markets.
So no big boom sort of moment in November.
Yeah.
And no. Okay. And so then currency-wise, though, I'm guessing that currency is something that we use to manage those risks that you're referencing about those things that happen off the back of a geopolitical event like oil?
We can use currency for that purpose because, as you'd imagine, a bit like people seek safe havens in a storm, people tend to gravitate to certain currencies. The US dollar, the Swiss franc, to name just two, the Japanese yen, possibly a third. People tend to gravitate to those currencies in a time of crisis. That means they appreciate relative to all others. You can use currency in that context for defensive purposes. But the other thing that's important to bear in mind with currency is it affects the value of an asset. If I hold a deposit in a US bank in US dollars and the Aussie dollar appreciates, suddenly my deposit as measured in Australian dollar terms is worth less. I may not want that. That's cash. I don't want my cash to depreciate in Australian dollar terms, so I might hedge that. So there are two uses to currency. One is a defense part of the portfolio. The other part is a consideration about the impact on value of your assets.
But it's certainly a thing that factors into getting the number that's on the tin.
Absolutely.
Okay. All right. Last of the four questions is around nation building. And there has been a lot of talk, particularly in newspapers and so forth, about governments, not just Australian governments, US, UK, wanting pension funds to do nation building. But I guess, and some members worry, well, is that the best use of my money? What would your response be to members who are hearing that and wondering what it means for them?
Well, the first and most important point I'd make to members is we have an overarching legislative need to invest in members' best financial interests. And so we approach every investment, whether it could be tagged as nation building or not, from the same point of view. Does it offer us a risk-adjusted return that's commensurate with similar assets that might not bear that same label? And does it add characteristics to our portfolio in terms of being a diversifying source of return to improve the label on the tin? Does it add that to our portfolio? If we can meet both of those criteria, in members' best financial interest from a risk-adjusted return point of view, and it's complementary to our portfolio, we're delighted to invest because it has that third order advantage of possibly benefiting society as a whole. But we don't start at that point.
No, and I think there's aged care homes or airports or telecommunication towers or caravan parks. They happen to be nation building, but that's not why we invested in them.
Correct.
Ian, what is your final message to our viewers? I don't know when you're coming back next on the show. Maybe you'll be back again soon, who knows? But what would be your final message to our viewers and listeners about considering investing with a super fund like ours? That's a really weird open question, but what would you say to them?
One of my favourites at the moment, and I wax and wane a little bit,
yes,
but one of my favourites at the moment is the markets, if you observe them, would lead you to believe that we sway between boom and bust. And that can cause uncertainty and anxiety. And the reality is, as one investor said, the world itself, the reality around us, is seldom different from not so good to pretty good. It's not boom or bust. And so what an investor ideally should be able to do is see that sentiment flowing through markets, boom to bust, and guard against that, because time and time again, sticking with a strategy and holding that strategy will deliver. And so if you have that time horizon and you've got good advice, and everybody who can should seek advice, I think that's the answer. Try and get yourself out of the reactionary to boom and bust, because markets will drive you crazy.
That's a beautiful way to finish. And for some reason, I've got in my head Goldilocks, and I can just right, just kind of perfect. I don't know why I'm thinking of Goldilocks, but there is something about that boom and bust and just right, and blocking out the noise. Ian, thank you very much for being on the show.
Well, thank you, Anne. It's
Have you
been
had
an
fun?
absolute pleasure. Absolutely.
All right. Well, we're thrilled. To our viewers and listeners, make sure you give us a great rating on wherever you get your podcasts or watch your videos. And please join us again soon. Thank you.